How often do you review each single position in your portfolio? Some look at their stocks every day, sometimes more, some only once a year. What is your frequency? Thank you.
Well, that sort of breaks down into two periods of my life. When I had more ideas than money, I was thinking about everyone all the time because I was thinking about buying the next one and which one I would have to sell in order to buy something even more attractive. So my opportunity cost, as Charlie would put it, then was the least attractive stock, which I would give up to buy something more attractive. So I literally, if I had $100,000 and it was all invested and I wanted to put $10,000 or $20,000 in something I felt was more attractive, I would be thinking all the time of which one of these do I unload. Now our situation is such that we have more money than ideas, and that means that we really aren't re-examining something every minute because the option is cash and not doing something that we really are excited about. We still think about the businesses we're in, whether they're wholly owned or whether they're partially owned through stocks. We think about them all the time. I mean, we've got a lot of information filed away in our minds, and you keep getting little incremental bits about that company or the competition or other things going on. So it is a continuous process, but it's not a continuous process with the idea that daily activity or weekly activity or monthly activity is going to result. It's just we want to just keep adding to our thinking, the knowledge, refining it further about every business that we're in. If we needed some money for a very big deal, for example, let's say we needed 20 or 30 or 40 billion dollars and we had to decide to sell 10 billion of equities, just to pick a figure, we would use the information we've been collecting daily, which hasn't really meant much as we've gone along, and then we would come to a decision about where we raise that $10 billion. Charlie?
Yeah, but even in Warren's salad days when he had way more ideas than he had money, he did not spend a lot of time thinking about his number one choice. He could put that aside and devote his efforts to other subjects.
Number 11.
Good afternoon. Charles Fisher from New York. In the last 18 months, the company has allocated at least $1 billion to 4 or 5 publicly traded companies. Berkshire has an abundance of capital and a scarcity of ideas. Since these stocks investments were made in large cap companies in which we could have probably made $5 billion in investments, have you thought about allocating more capital to each stock investment?
Yeah, we do think about that, obviously. And there's certain ones that we have added billions of dollars to that we already had substantial positions in a couple years ago. Obviously, when we add to the present list, we think we're adding to the ones either that look the most attractive to us or to the ones that we can just buy. I mean, there are some things where we can't put that much money in, or where we will hit reporting thresholds that will cause a problem. If we own over 10% of a company, if we can't sell a share of it then for 6 months without it being, if there's a profit, it being recaptured pursuant to a short swing rule. So there's some technical things that enter into whether we cross certain thresholds of ownership size. But if you look at the portfolio at the end of 2007, you're going to see that certain positions in there from 2006 have probably been increased by billions of dollars, and that's always something that I'm considering and Charlie's considering. We like to add to present positions. I mean, those are companies we know, understand, obviously like to some degree, and if the price gets reasonably attractive and we got money around, we will add. If we can find a good business to buy, we will sell the least attractive. Charlie?
Yeah, it isn't as easy as it looks to buy these big positions. When we were buying Coca-Cola, we were buying every share we could with 30 or 40% of the daily trading.
Yeah.
And it took us a long, long time to get our position. And there are huge difficulties to managing great big common stock portfolios. Now, we like it way better when we have those problems now than we liked it when we didn't have them early. But it does make it much harder. We have no easy way of moving these elephants around.
In general, we think we usually can buy something like 20% of the daily trading volume and feel that we're not causing the price to be violently different than it would have been if we hadn't been participating in the market. So that means if we're going to buy $5 billion worth of something, $25 billion worth of it's going to have to trade. And that's a lot for many stocks. So we are a big ocean liner, and that has its disadvantages compared to being a smaller boat.
What are you doing to protect our company's portfolio against the perils of inflation? Specifically, are you looking at further currency investing and metals investing?
Well, we would not necessarily look at metals investing as being any protection against inflation at all, but we're the best protection for inflation is your own earning power. I mean, somebody that is a first-class surgeon or lawyer or teacher or salesperson or anything else, whether the currency is seashells or paper money or whatever, will do all right in terms of commanding the resources of other people. So your own earning power is the best hedge against inflation. The second best hedge is to own a wonderful business. Not a metals business necessarily, not a raw material business, not a minerals business, but a wonderful business. And the truth is, if you own Coca-Cola, if you own Snickers bars, if you own Hershey bars, if you own anything that people are going to want it to give a portion of their current income to keep getting, and it has relatively low capital investment attached to it so that you don't have to keep plowing tremendous amounts of money in just to meet inflationary demands, that's the best investment you can probably have in an inflationary world. But inflation is bad news for investors under almost any circumstances. You can argue that if you owned some business required very little capital investment and had real flexibility of price during an inflationary period so that people will continue to give up a half an hour of their own work every month to buy your product, and you leveraged it, then you might even beat inflation to some extent. But leverage is not our game. But we try to own good businesses. I think that Berkshire would not do as well during high rates of inflation at all as it does in real terms, as it does in periods of low inflation. But I think we would do better than a good many companies. Charlie?
I've got nothing to add.